right? So, professional traders, they don't waste a lot of time or a lot of days losing, losing, losing. They know when to cut their losses and they know where to take their profits.
All right, joining me will be Matt Buckland, founder of Exchange-ify, who offers a very interesting platform that occupies an area of ETFs that is absolutely white hot, in my opinion, and that's 351 exchanges, which, if you're not familiar with these, essentially these allow investors to contribute a portfolio of individual securities into an ETF. And the big key here is if this is done correctly, this is not a taxable event. And so an example would be to think about an investor who owns a fairly concentrated portfolio of individual stocks that have gone up quite a bit. So I always like using the example of stocks such as Apple and Tesla, Nvidia, stocks that have gone up substantially over the past several years. And now, because of that, these stocks have overwhelmed an investor's portfolio from an allocation perspective, right? The investor is now overweight these positions, which of course introduces concentration risk. Well, a 351 exchange allows this investor to contribute those stocks into an ETF. And in return, they receive ETF shares. And again, the investor is not taxed until they actually sell out of those ETF shares. And so if you think about what the end result of this is, the investor is obviously delaying paying those capital gain taxes, but they also now have much better diversification. And then obviously they get all of the other benefits of ETFs that I always talk about on here. So Exchange-ify, they are a platform that connects investors and advisors with ETF issuers who are doing these 351 exchanges. And so I'm going to have Matt explain all of this in much more detail. And we'll also go through many of the key considerations around 351 exchanges themselves. Now, later, I will be joined by Paul Marino, Chief Revenue Officer at Themes ETFs, who, as you might gather from the name, they offer a number of thematic ETFs, such as the Themes Transatlantic Defense ETF, ticker NATO, which is a great ticker symbol, by the way. And then they are also behind the Leverage Shares ETF lineup as well, which is comprised of leveraged single stock ETFs. And so we're going to have a conversation around how they're positioning in both of those categories and highlight several of their ETFs. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. So let's start this week with Matt Buckland, founder of Exchange-ify, who is joining me from Palm Beach Gardens, Florida. Matt, it is a pleasure to connect. Thank you for joining me.
Thanks so much for having me on, Nate. I am a fan of the podcast, and I'm excited to talk to you about all things 351, which I believe you called last year as one of the big trends in the industry, right?
You're already buttering my bread here before we even get rolling, which I like. It's amazing because this is a very hot topic in the ETF space, and I thought this would be a very timely conversation to dive into these because investors and advisors are certainly hearing a lot more about this topic. And I guess before we get into all of the details and considerations around this, why don't we start first with what Exchange-ify does to sort of set the backdrop here, and then we can again get into detail on 351 exchanges themselves and go from there. So do you want to just explain at a high level how your platform works?
Sure, thanks. Your intro was great. That explains it well. It's a platform to connect wealth advisors who are dealing with tax problems and concentration issues with ETF issuers who are working on launching an ETF and are offering this 351 exchange opportunity. So I like to think of it as like the iCapital for ETFs. We can go raise seed money. I got into this while I was working on launching my own ETF, which hasn't launched yet. It's work in progress. It's hard to do. I went to the Yale School of Management, and I thought if something tracked Yale's endowment, and I had the ticker symbol Yale, which I reserved, that this might sell pretty well. And I'm working on it. It'll be out soon, I hope. And I'd learned about this 351 exchange because there was a family office that had been tax loss harvesting for a long time, and they wanted to put some money into an ETF. And so I thought maybe I can get some others who are interested in this as well. And I put up the website 351conversion.com with a sign up form. And within a month, I had so many signups from both sides of the transaction that are interested in this, from investors and their advisors and from ETF issuers. And I realized this is a fantastic opportunity to connect everyone and to provide some software for the whole transaction. Because as I learned, hundreds of millions of dollars of securities are transferred around on spreadsheets. And my background is entrepreneurial, and I've done some tech, and I realized that software could help facilitate this whole transaction and ensure that it's compliant and easy to do. Because my idea is, if it's easy to do, more people will do it. So the one thing, if you've ever tried to follow the diversification requirements and optimize a portfolio for the maximal tax deferral, as well as stick with the 25/50 diversification requirement, it's actually pretty complicated. So you have all your tax lots. You have to, the look through rule means you have to take apart the ETFs into all their individual components if you're contributing ETFs. Then you have to combine all the positions, and then you have to run solver with a whole bunch of constraints, and then put it back into its original portfolio. And there's a lot of room for error in this. So that's the first thing we did. We've got software that anyone can use. You just upload a portfolio, and it'll automatically optimize it for the diversification requirements and compliance. And then we've got some tools on the ETF issuer side, because they're separate portfolio checks that they need to do. They have their own aggregate portfolio diversification requirement checks, and then some strategy alignment checks. So we can do that once the portfolio is complete before the exchange. It works with live market data, so you can do this right up to the moment of the exchange, because as we know, things fluctuate all the time. And right now, we're working on full integrations with all of the parties involved. Right now it's Fidelity, Schwab, Pershing, the custodian side, BNY, US Bank, State Street. So those are the main players in the space right now.
And just out of curiosity, what is the business model here? Do you charge a fee to access this platform, or how does that work?
So right now it's free for advisors. I know you've got a lot of advisors in your audience, so you can register, use the portfolio optimizer for your clients. You can set up a client dashboard with all their information, and screen all of the open opportunities on the dashboard. And then it's after the optimization, you can download the spreadsheets in the format that it needs for the security transfers. And you connect with the ETF issuers on there. And then there's a listing and marketing fee for the ETFs that are on there that would like to market their opportunity and raise capital. So I want to make this the go-to place for all things 351 Exchange.
Okay, so with that as a backdrop, let's now get into some detail on 351 exchanges themselves. And you heard my high-level description there at the top. Perhaps you can elaborate on that. And it might be good if you offer just a really quick history on 351 exchanges as well, just kind of how we got to this point.
Sure. So there are a bunch of like-kind exchange provisions in the tax code. At a high level, the idea is you are just swapping your economic exposure in form. And there's, everybody knows the 1031 in real estate. There's the 1035, 721 is a partnership. 351 was meant to encourage corporate formation, and it's an old provision in the tax code, about 80 years old. The idea was that people can contribute their assets to a new company and get issued stock in the company and still have the same economic exposure to the assets that they contributed, but it's not a taxable event. It's a swap of exposure and not a sale. So the IRS determined that you do not have to pay taxes on this. In 2019, the ETF rule came out. There were some updates, but basically the ETFs became their own registered investment company. The idea is that a registered investment company is in the business of holding a diversified basket of stocks. So if you have a diversified basket of stocks and you swap them for shares in an ETF, you are not changing your economic exposure, because markets are efficient. So who knows? You're going to get a diversified basket of stocks. This tends to get similar outcomes. So you're just changing your economic exposure with a diversified basket of stocks for shares in the ETF that holds a diversified basket of stocks. The history, from what I understand, the first one was done in 2019. It was SSPY, Rory Riggs launched it. And after that, it was a few family offices that got into this. And then there were asset managers who started converting their clients' SMAs into ETFs all in-house because it's easier to control. And the idea was that it's the same trading strategy, but if they can get their clients' assets into an ETF, they at least won't have a tax bill at the end of the year if they're not liquidating some of those shares. So it's better for their clients and more efficient for the asset manager. They can lower fees, everybody wins. And then more recently, just in the last year or so, there have been some syndicated 351 exchanges where an asset manager will go through the process of converting those SMAs into an ETF. And in the same time, they will open up the opportunity, since they're doing the work, to outside investors to contribute securities at the same time. So they'll say, I'm going to convert 200 million of my own clients' money into an ETF, and I will market this strategy and maybe try to gather another 100 million. So I get to launch and gather assets, and everybody benefits from going through this work. There's a little bit of confusion with exchange funds. Most of the calls I get start with some advisor saying, my clients ask me what the heck this is. What about the 7-year lockup? And I say, no, this is not the same. This is an ETF. This is fully liquid. Everything you know about ETFs applies once the ETF launches. There's some confusion around this Vanguard dual share class thing where you can swap your mutual fund for your ETF shares at Vanguard only. A lot of people start asking, is this legal? And of course it's legal. Lots of people are doing it. And so that's kind of the background and the history and how it's being used right now.
You mentioned that there are some diversification requirements in conducting one of these 351 exchanges where any one holding can't be more than 25% weighting. The top 5 holdings can't be greater than 50%. Are there any limitations in terms of the types of securities that can be transferred in a 351 exchange?
Well, there is a whole bunch of legal gray area around this now, just because there hasn't been a lot of guidance and there hasn't been any enforcement on this. So it depends on who you ask, which lawyer you call. Generally, it's very easy to transfer into an ETF anything that is liquid, traded intraday on an exchange. And so that's stocks, ETFs, bonds, anything like that. In theory, there's lots of mutual fund conversions. Mutual funds get rolled into these sometimes, so that's possible, not generally done. Cryptos, I just wrote a paper on this. It's a little more complicated. Illiquids, I just saw the Ron B ETF has 22% allocation to SpaceX, which I think he's going to have to get down below 15 pretty soon. But eventually the original idea was to transfer in a liquid asset. So maybe that could be part of it. So that's eligible assets is one of the legal gray areas, and it depends on who you ask. Strategy alignment is another one of these legal gray areas. So it depends on which lawyer you ask. Some will say if you file for a value strategy, 100% of the stocks you take have to be in the value strategy. Other lawyers will say, no, 0%, because the idea is corporate formation. So you are just seeding a company and the company is then doing what it's supposed to do. So it doesn't matter if it's in the prospectus or not. They're supposed to then rebalance into what the strategy is. I've heard 30. I don't know where that comes from. My guess would be 80% aligned, because if you look at a lot of there's the names rule, and if a fund should have 80% of its assets aligning with the name of strategy of the fund, but the 20% is up to the discretion of the manager, that might be safe. I don't know. I'm not a lawyer. But the thing is, most ETFs that are launching and doing this, they're an active strategy. They say it's up to the discretion of the manager, so they can kind of accept whatever is given to them. So the other big legal gray area is just trading out, how quickly you rebalance into the approved strategy that the manager wants from the accepted securities in the 351 exchange. Some lawyers will tell you do it the first day. It doesn't matter. Other lawyers will tell you do it over a year. Otherwise, it looks too much like a tax dodge. I don't know. Who knows, right? Who knows what the next year is going to look like? Again, markets are efficient. A diversified basket of stocks should perform the same as any other diversified basket of stocks. We don't know in advance. And then I guess the other thing is just this operational complexity of it all, which prevents you from taking mutual funds and cryptos and illiquid assets and all of that. And that's a lot of that is just what Exchange-ify is hoping to solve with the software solutions.
A couple of quick questions there on those comments. The strategy alignment, just to be clear, what you're saying is there's some gray area around whether the securities being contributed to the ETF should align with whatever the underlying ETF strategy is, correct?
Right. So if you say I have a large cap growth strategy and somebody wants to contribute a big position in a small cap stock, the ETF issuer may or may not accept that. And I've seen some where a pretty large small cap position is just rejected from the exchange, and that's just up to the discretion of the ETF sponsor and their lawyer at this point. But there's just one of those confusions. I mean, I think these confusions are what's preventing a lot of the larger big wirehouses and asset managers from getting involved, because they just don't have clear guidance and they're not sure what to do yet. But this is going to change as the industry evolves and it gets easier to do. On the wirehouses too, I imagine that the other thing is they just don't quite know how to monetize this yet. I imagine they'll get to a point where they're charging commissions. And then I deal with this too, an advisor from Morgan or Merrill or UBS or Wells Fargo wants to do an exchange for their client, but they have no way of getting those new ETF shares back onto their own platform because they haven't been approved yet, because the rules are they haven't been around for a year. And so, they maybe could get it back, but then they couldn't trade it. So there's just a lot that needs to evolve. This is quite new. It's going to be big, like you called, but I think it's still in the early days, because this is it's such a win-win-win for everybody. I mean, the investors get tax-deferred diversification into an ETF, which is the best structure for holding capital. Obviously, the efficiency, liquidity, transparency, and they get to continue compounding from a higher base level. Advisors get to provide a non-commoditized, high-value service to their clients. They often make a fee because they're moving legacy stock positions, are sitting on the brokerage side into the advised side, and then they're earning a fee on it. And everybody wins because they've saved so much money in taxes. And then the ETF issuers, it's kind of a no-brainer. I mean, raise seed money before you launch, obviously. It's like the easiest thing I've ever had to sell.
I think most listeners of the show understand the basics around ETF creation and redemption, but I guess just to ensure that we're thorough here, do you want to explain the basic mechanics of that? And the reason I'm asking you here is just, you mentioned that there is some gray area around how quickly an ETF issuer divests or sells, or in this case, redeems the holdings that they're receiving. And then obviously this also ties in just to the overall tax efficiency of the ETF structure itself. And so maybe take it from more of the standpoint of what does the ETF issuer actually do with the individual stocks that are contributed to the ETF, if that makes sense.
Sure. And I think for your audience, probably help to start with, from the advisor's perspective, how this all works and how the creation redemption process benefits you. So from advisor's perspective, they're going to Exchange-ify, they're screening deals, they look for the strategy that works in their portfolio. They sign the participation agreements, they optimize their portfolio, and it gets sent off to the brokerage for the securities to get transferred to the custodian for the ETF. The day before launch, market close, they figure out how many shares of the new ETF need to get created. And so there's a swap of shares for ETF shares. Those ETF shares get sent back to the brokerage accounts where they came from on the day that the ETF launches. In general, once the ETF is live, the process is that a authorized participant who works with the ETF sponsor, they will buy securities on the open market and swap them for shares with the new shares created with the ETF issuer. If there's demand for shares, they're managing the spread. So they're just just doing a swap of shares of all the stocks that are supposed to be in the portfolio for new shares in the ETF. And then the AP sells them on the open market to manage the spread and make sure that the ETF shares are in line with the portfolio. So that's the swap, the part where it's not a sale like a mutual fund. It's actually just a swap, and that's what helps ETFs be tax efficient. And there's lots of confusion around that as well. I mean, um, you know, the ETF, there never really is going to be a taxable event because of this whole process. But in theory, they could, and they're managing their tax lots. But from the advisor's perspective, it doesn't matter. You transferred in the securities at your cost basis. Your cost basis stays the same in those ETF shares going forward.
And I think we should emphasize the point that these are a one-time deal, right? In other words, once a 351 exchange takes place, once the ETF is seeded and launched and it's live and trading, that's it, right? This isn't an ongoing process.
Well, actually, that's another legal gray area, and I've heard from different lawyers that this is possible as well. So there's the control rule, which doesn't really apply because every ETF that's launched so far has been at inception. And so there's this 80% control rule. All the new owners of the shares need to own 80% of them, outstanding shares. At launch of the ETF, everybody who owns shares in the ETF owns 100%. So that point is null. But if you have an ETF, and there are a lot of ETFs out there with very low AUM, and you can come up with 4 to 5 times the AUM to exchange in, you can create new shares into a 351 exchange into an existing ETF. It hasn't been done. I'm working on it. We'll get there. But that's another thing that's evolving in the space as well.
I'm getting the clear impression from you that this is absolutely an evolving area. So not only is it white hot, it's evolving. There's a lot of gray area. So it makes it all really fascinating. Let's talk some more specific use cases. So again, I gave the example at the top of just somebody who has a concentrated stock portfolio and they have large embedded capital gains. They now want to diversify, but they don't want to pay those taxes. What are some other specific reasons why an investor or advisor might want to pursue a 351 exchange?
Yeah, despite what you might think, this is not just for the super rich. I would say the most common use that I have seen through the Exchange-ify platform is somebody who either made a lucky stock pick a long time ago, like your example, they might have bought Apple in the 90s, or they might have bought Tesla in the early teens, or they worked for a company and participated in their employee stock purchase program. And now very large portion of their portfolio is in one stock, and they need to diversify as they're approaching retirement because they're nervous. So that's the most common use case. Another one is re-indexing. There's $1 trillion in tax loss harvesting funds now, and eventually you run out of things to sell, and you need to get back to broad market diversification. Another interesting one that I keep seeing now is avoiding forced capital gains events. So a company is getting taken private, and you own a couple $1 million in shares in that company, and you didn't want to sell and didn't want to pay capital gains taxes on it. You can do an exchange before that the buyout goes through and the cash hits your account. And so you have ETF shares and they'll deal with the transaction. Or if an ETF is closing, because a lot of ETFs do close. It's happened to me. And when it liquidates, you get cash in your account. You have to pay capital gains tax on that. So that's another use case. And I think a lot of these smaller ETFs will end up getting rolled into each other. Just rebalancing, repositioning. Advisors are doing this as people approach retirement. U.S. growth has done so well. They're looking for more value, more equal weight, more international at this point, some income as people are approaching retirement. We're just simplifying the portfolio. It's kind of a mess, and they've got some high fees funds in there and things like that. They just kind of want to clean it up without having to pay a big capital gains tax bill.
You were alluding to this earlier, but I think people listening to those potential use cases, they may go, this all just seems too good to be true. And that this is clearly a huge win for investors if done right, but maybe this is not so great for the IRS. And so where I'm heading is, could you envision a scenario where Congress looks to shut down 351 exchanges like this? And nobody knows what politicians are going to do, right? That's tough to handicap. But do you think that's a realistic scenario?
You never know, but I don't think so. And I'll tell you why. I think that this just makes the tax code fairer for equity investors as compared to real estate investors. I mean, I know a lot of people have made a lot of money in real estate because there's all these tax benefits for them. And you're not really putting off, you're putting off the taxes. You're not resetting your cost basis. So the taxes will get paid eventually. Um, some guidance from the IRS around this would actually be good for the industry. It would allow people to have some clarity to do more of this. But at this point, it would take an act of Congress. I know Senator Ron Wyden has talked about closing this loophole, but I don't think it's a big priority. And the way I think about it is the carried interest loophole has broad bipartisan support by everybody except people in the private equity industry, and that hasn't been closed for decades. So probably they're not going to get around to this.
Coming back to your platform again, you are connecting investors and advisors with ETF issuers who are doing 351 exchanges. Do you have a couple of good examples maybe you can offer in terms of some opportunities that you help facilitate? I think that might be interesting for people to hear.
Sure. I've been doing this probably 6 months, so it's not don't have a long track record in this. You can go on the platform and see a history of syndicated launches and how much they've raised, but the ones that have launched that have done very well, and I cannot take nearly even the majority of credit for these, but Mab Faber and Wes Gray are just phenomenal, so smart, and been pioneers in this space doing serial 351 exchanges. They've launched some very successful funds. The Global Equal Weight one, I had at least 3 advisors come through the platform and contribute assets to Global Equal Weight and the US Equal Weight, and they told me they had a great experience. And same with Alpha Architects, AAUS and AEQ. And I've got a few on there that are closing now. Advisors that I talk to are generally happy with the strategy that they are moving into. The NPF Advisors has one that's closing soon. We'll launch pretty soon after. Bernie's, Astoria, you've had Bruce Levine on your podcast talking about their strategy. Taves Asset Management, Philip and Evan are out there doing a great job promoting and educating advisors on this. Ethan Powell of Brookmont's got a great strategy he's launching one with. Argent's on there right now looking for assets. And I've talked to so many ETF issuers. I imagine the pipeline will be very full soon, but there's just a bit of a lag because you have to file with the SEC and you have to get your prospectuses approved, all your material ready to go. And so I know a lot of people are working on this. And I expect by the end of the year to have 50 to 100 of these opportunities on Exchange-ify.
Yeah, and you mentioned earlier, but I think this bears repeating from the ETF issuer's perspective. This is obviously highly beneficial because these 351 exchanges allow an ETF to start with meaningful assets on day one. We all know how competitive the ETF space is, and clearly having those assets allows the ETF to hit the ground running. So I just think that's an important point, particularly from the ETF issuer perspective. So you mentioned a pretty full pipeline. I guess just add some color moving forward in terms of how big you think 351 exchanges are going to be in the ETF space. And I know you probably have some stats on how many of these have already happened, but just talk more about what you think might happen moving forward.
Yeah, this is the way I think about it. So right now, market beta is very cheap, easy to get. Outperformance is difficult. The market's doing very well. So you focus on the things that you can control, which is the number one controllable portfolio risk is concentration, right? If one stock, it goes to zero, you have no money. If you have a diversified portfolio, one goes to zero, you still have most of your money. And then the number one controllable cost is taxes. So advisor has a fiduciary duty to help their clients get diversified and reduce their taxes. So the 351 exchange solves both of these problems. So I think just logically, this is going to be big. People focus on diversification of taxes. And, the way I think about it, the top 10% of Americans own $45 trillion in stock market wealth. There's $1.5 trillion inflows into ETFs last year, cash, 300 ETF issuers, over 1,000 ETFs launched. I imagine about a third of them are 3-5 oneable. I mean, not single stock leverage and inverse gambling products, but like diversified portfolios you could put your money in. And then there's thousands of asset managers and hedge fund managers out there who would like to have their own ETF and put their strategy into an ETF. And I love Matt Levine. I follow his stuff, and he's always talking about how you can package any trading strategy into an ETF. So I think As Exchange-ify evolves, as the software makes it more compliant, as people get trust in the process, this could be the go-to place for all things 351 and really accelerate the flow of capital into ETFs, because this is really where investors want to put their money now. It's where all the innovation is happening, and it's an exciting time for the industry.
So what I took away from all of that is my prediction last year of 351 exchanges going mainstream was an absolute home run on the point, right? Matt, such an excellent job of explaining everything this week. Again, there's clearly a lot of momentum around 351 exchanges. What's the best website if people are interested in learning more about these? Where should they go?
So Exchange-ify.com has a lot of information on it. It's got the dashboard. If you register as an advisor, you'll see the dashboard, and you can create your clients' portfolios on there and use the software. And same if you're an ETF issuer, you just do the same sign up process, and you can create a ETF issuer account there as well, and use the other tools on your side, on the fund sponsor side.
Well, again, great discussion this week. Thank you for joining me.
Thanks for having me, Nate.
That was Matt Buckland, founder of Exchange-ify.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with VettaFi and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between VettaFi, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR.
I'm now joined by Paul Marino, Chief Revenue Officer at Themes ETFs, who currently offers 17 ETFs under the Themes brand. Those have about $300 million in assets. And then they are also behind leverage shares, which are leverage single stock ETFs. That's another 73 ETFs with nearly $1 billion in assets. They are a very unique ETF issuer. And Paul is now joining me from Greenwich, Connecticut. Paul, it is a pleasure to connect. Welcome to the podcast.
Yeah, great to connect with you too, Nate. Thanks for having me on.
All right, so I thought let's start with a backstory on Themes ETFs and how you're currently positioned within the ETF space. And it's interesting because for people unfamiliar, all of these nearly 90 ETFs I mentioned, these have all launched within the past 2 years or so. So clearly you and your team have been extremely busy, but introduce everyone to Themes ETFs.
Yeah, so we're a startup ETF provider. But we have a lot of experience on our executive team. So everybody's got a lot of years of experience, either in asset management or in the ETF space. Our founder, Jose Gonzalez Navarro, was a founder at another firm, very successful. But when they were bought, he decided to go his own route. So originally, starting an ETF provider in Europe, leverage shares, and it became the largest leveraged ETP provider in Europe. And then when he was done with his non-compete, decided to launch in the United States under the Themes brand. And that was a thematic and sector-based shop. That's how we started. We launched 17 thematic and sector-based ETFs in high-growth areas of the market. And then last year, we decided to enter the leverage space in the U.S. as well. So it's been a prolific rise from literally no assets, getting the products together, getting them launched, to about 1.3 billion in assets today and growing. And we're really excited about what we offer and how advisors and the retail side is receiving it.
Well, let's talk about each of these lineups one at a time to, again, help people become more familiar with what you're doing here. And first, I'll ask you about the Themes branded ETFs, which, as you know, Paul, there has been a ton of product proliferation in the thematic ETF category. And so I'm curious, how are you differentiating yourself here? What makes you unique?
Yeah, so first and foremost, we are in high growth areas of the marketplace, not just for today, but where we see a long runway for growth. So that's really important to us. The second thing that I would say is we are a pure play. So when you're investing in one of our thematics or one of our sector-based ETFs, that you're getting pure play exposure to whatever that theme is, whatever that sector is. We don't try to include other things to try to juice performance. You're going to get exactly what we're offering. We're a passive manager for the most part. We only have one active strategy, and I can explain that active strategy. It's really not active. We just don't need an index to mirror what we're trying to do. And then last but not least, low cost. One of the things that we believe is that costs matter, management fees matter. So we're growing this thing to scale. So we started off with our management fees low. We intend to keep them that way. And we think that's very important for long-term returns for advisors and investors.
So to give people an idea, what might be a couple of ETFs that you would highlight that sort of drive home how you're approaching the thematic ETF category? And I mentioned NATO at the top of the podcast. You can certainly talk about that one, or if there's another ETF, but what would be a good example here of how Themes is approaching the market?
Yeah, so let's start with NATO. So the Transatlantic Defense ETF by Themes. It's a pure play on aerospace and defense companies in NATO member countries. So it's very, very specific. Why did we think that was important? Well, because of everything that's going on geopolitically and what the administration is doing to reset its relationship with NATO. So how does that impact the portfolio? Well, it's based both, the companies that we select are based in the United States and in European NATO member countries. And as you've seen with the new positioning, NATO member countries now have a bigger responsibility to build their own defense, number one. They have to increase their spend from 2% to 5%. And we, instead of trying to predict where the puck is going, that famous Wayne Gretzky saying, we look to where the investment's going, and the investment's going there. So we eliminate tech out of the portfolio. A lot of our competitors will add tech to juice up returns, but we think investors get enough exposure to tech in their broader portfolio and asset allocation strategies. So we wanted to be a pure play on defense. And what you see is very, very robust returns. And the reason is when you look at the companies that are inside, RTX, Lockheed Martin, L3 Harris, Northrop Grumman, and then on the European side, Rheinmetall, Safran, Airbus, Rolls-Royce. These are the companies that are receiving prime contracts from governments in NATO member countries. And when you get those prime contracts, you're getting the majority of the investment. So the strategy's done really well. It's a pure play on defense and at a very low management fee.
Okay, so certainly NATO is a good example. Is there another ETF you might point to or highlight? Again, you have a whole lineup of these, but just to help people get a better idea.
We have an ETF called GSIB, Globally Systemically Important Banks. This is the only active strategy that we have because we don't need an index to mirror it. But essentially what we do is every year, the Financial Stability Board and Basel III Committee select 20, the banks, the financial institutions that they deem systemically important. And that's what the portfolio is comprised of. So it's 29 companies, the largest financial institutions in the world that are deemed systemically important, that have the most deposits, that are integrated, that are making investments globally, and who, central banks have deemed so important that if something were to happen, there could potentially be a backstop to help support them. That's what's happened historically. So again, performance has been tremendous. It's one of the top performing, if not the top performing ETF in its category of 44 since inception. We think that performance can continue. And traditionally, financial institutions have been valued, very stably, safely. But we think with fintech coming on board, their ability to invest in fintech and scale, you could see those valuations go up. So we think there's a lot of room for this category to run. And we like the big banks and the big financials.
You mentioned performance. I have to tell you, I was perusing your ETF lineup this morning, and there was an ETF that absolutely jumped off the page at me, and that was AGMI, which is the Theme Silver Miners ETF, because of course, silver has been one of the biggest stories in the markets recently. And this ETF is up nearly 240% over the trailing 1 year. Do you want to talk about how Themes is approaching silver miners? Very timely.
Yeah, so silver is an industrial metal. It's an important component in the electrification of all things. That's number one. Number two, the spot silver has been historically undervalued, and people have been waiting for it to catch up. And what the miners do is they give you an amplified return. So they were operating at a very low spot price for a long period of time. So they became very efficient. Now that silver has taken off, and we think, there's a long runway, not just for silver and gold, but for other commodities and other industrial metals, especially with what's going on with infrastructure build and with fiat currencies and people losing faith in fiat currencies. So we think hard metals are a great space. And, yes, the miners are an amplified return on that. So you see great performance in our silver miners, great performance in our gold miners. A lot of people ask me all the time, Nate, like, did I miss the move? Did I miss the move? I can't tell you whether you missed the moves or not. We don't make recommendations, but I can say if you're looking at, where to put some money in industrial miners, you might want to start to think about adding to something like a copper or a lithium, and definitely uranium for all of the build out that is going to happen, for energy needs of AI and the new tech frontier. And that's going to be powered by uranium and nuclear energy.
All right, before we move on and talk leverage shares, I'd love to have you perhaps offer a few key tips that advisors might use when conducting due diligence around thematic ETFs. And again, I mentioned earlier just the sheer number of thematic ETFs that continue coming to market. So how do you think advisors can best sort through these?
Yeah, I can't tell you, like people just think because it says it's a category, that it is that category and that they're getting that pure play. So number one, the great thing about ETFs is they're transparent and you could see the holdings on a daily basis, right? So I would encourage them, number one, to make sure they know what they're investing in. The second thing is fees. There's no reason to pay more to get exposure to a sector if you don't have to. So make sure that the fees are not just competitive, but that they're as low as they possibly can for that sector that you're getting. Make sure that it's a pure play on that sector, because even if you're looking at the holdings and you're sort of comfortable with the holdings, is it a pure play in exactly what you're sort of investing in? And then last but not least, make sure you can trust the carrier that they're going to be around. Like, what is their history? What is their background? Are they building a lineup to last? And I think those are the key and critical things that are super important. And one other thing that I would say is make sure you don't have a tremendous amount of overlap in all of your other holdings, because, a lot of times people just think like, oh, I'm going to invest in, semiconductors, AI. These are all really good themes that I hear about and that I read about, data centers. And then you look at the portfolios and they have a lot of the same names in there. So just make sure that you're not creating too much overlap with your asset allocation portfolios.
I think all excellent tips, and I'll emphasize too that you mentioned there certainly the overlap in that I've seen plenty of examples where investors, they invest in a thematic ETF only to find out they already own all of those same holdings in their core portfolio. And then I think it's somewhat related, but the pure play, because if you're going to invest in a theme and you're right in where that theme is heading, you want to make sure you get the full benefit of that. And again, there are plenty of examples historically where investors get into a thematic product, they're right directionally on the theme overall, but the ETF itself doesn't capture them being correct. So I think having pure play exposure clearly is key there.
Don't treat it like a mutual fund. Like, size doesn't matter the same way that it does with a mutual fund. What matters is the underlying liquidity. Like, we can create a market for anybody who wants to invest in our funds. And so make sure that if that's the exposure you want, be in touch with the ETF provider. We can make sure the bid and the ask spread is there for you. And if the underlying holdings are liquid, it's much different than a mutual fund. We could create the capacity that people need.
Such a great point. Always contact capital markets at any ETF issuer. Okay, let's move on and talk leverage shares ETFs. As I noted, you do currently offer 73 of these in all. just talk about the overall product lineup here. So I see single stock leverage ETFs, and then I also saw these capped accelerated strategies. So tell us about the lineup.
The beautiful thing about an ETF is such a great wrapper that you can create lots of different strategies inside of them. So we could start with the leverage 2x long ETFs that we have. So, leverage has existed in investing for as long as investing has been around. Generally reserved for professional traders that understand either how to leverage up using options and can get those options at a reasonable cost, or they understand how to short products, borrowing the stock and using margin. But that's kind of dicey for the retail investor. And what we saw was an appetite for retail investors to compete on a more level playing field with institutional investors. So this is a way to do that. So we literally create the leverage inside of the ETF using swaps. And then we offer 2x up or down for whatever that underlying security is. Now, it's important to note that, a lot of people will say these are gambling products, so and so. We don't think so. These are just ways to amplify leverage when you have high conviction. And it's no different than what a professional investor would do. And the great thing about these ETFs is you can gain that exposure very, very easily. And if you need to pivot, or you're wrong, or you missed the move, you can trade it very easily and get out of it, just like any other ETF that's out there. And you also have access to it pre-market, post-market, which is a little bit different than the options market, because a lot of these big moves are made before the market or after the market. So you have lots of flexibility. They're trading vehicles, and it's important to say that they reset daily. So they're not buy and hold strategies like our thematics are. So you really have to have a process in place as a trader for when you want to gain that exposure and then when you want to exit.
Well, that's actually what I wanted to ask you more about. You made the comment that, there's this narrative out there that these are gambling products, and you'll certainly see some investors and pundits and media types, they like to criticize these products. They say investors will get burned. They'll say the math of these products is such that the ETFs are designed to go to zero, right? Those sorts of things. So I guess talk more about that, because clearly you mentioned earlier, leverage has been around forever. This isn't a new concept. And I'm guessing you would say that products like these democratize access, they make it easier. But talk about some of the negative stereotypes or negative narratives out there.
Well, so many people speculate in the stock market, and that's just the nature of it. There's sort of a gambling characteristic, especially if people aren't professional investors. But that's not going to go away. You could save everybody from themselves by just saying, we're not going to give you access to a brokerage account, but that's not the way that it works. Like, everybody has the ability to have access, and I'm not sure how they would protect them if they're going to allow them to invest in options. Options are tougher to deal with and tougher to calculate, and they could cost more. And how many people lose a ton of premium just by getting the calculation on the strike price wrong and the expiration date? So, I think whenever there's innovation, whenever there's a change, whenever there's easier access, people start to scrutinize that more, and they start to be more critical of it. But we don't see it as that way. And plus, I will also say, the world is changing, especially when it comes to investing with all the new platforms. There's a little bit of a gamification that's there. So we're looking at, places like Polymarket and Kalshi, and, we're betting on things that have, that you can't even do due diligence on. It's just the probability of something, right? So as that enters into the marketplace, I would be much more comfortable with somebody coming to me and saying, I like where NVIDIA is valued, and I love their growth story. I'd like to take an amplified approach to that. That to me is more healthy than trying to, put money on who the next Fed chairman is going to be.
Okay, so outside of obviously an investor making sure they understand how these products work, what would be some key tips you would offer in this category to investors looking at these single stock leverage products, which again, this is a growing category, just like we talked about on the thematic ETF side. So what are some things that they should be looking for?
Have a process for how you trade. Make sure that you're not getting out over your skis, meaning, I was on a podcast the other day where somebody told me that they were going all in short silver. I literally said a prayer for them immediately and was like, please, like make sure you're not going all in any direction. And I think about that guy every day as I see the silver price continue to go up. So have a process, make sure that you're comfortable with the risk that you're taking and the dollar amount that you're taking. Understand that these are trading vehicles and know your exit, up or down. Right. So, professional traders, they don't waste a lot of time or a lot of days losing. They know when to cut their losses and they know where to take their profits. So make sure you understand that these are not buy and hold strategies, that they need a process, a trading process around them. Know how much you want to lose, know when to take a profit, and be really, really diligent about sticking to your process.
Well, Paul, with that, really enjoy the conversation this week. Certainly want to wish you and the entire Themes ETF team the best of luck moving forward. Thank you for joining me.
Oh, anytime, Nate. I really appreciate your podcast. I love all the material. And I'm not only a guy that likes to be on it, I love to listen to it too.
Well, thank you very much. That was Paul Marino, Chief Revenue Officer at Themes ETFs. That'll do it for this week's ETF Prime. I'm excited to tell you that I will be at Exchange 2026, where I will be taking the stage and even recording a live episode of this podcast. This is your chance to join me alongside a community of top advisors and industry experts for a few days of world-class content and unparalleled networking. Secure your spot today by visiting Exchange-ify.com. Next week, I will be joined by Christopher Getter, who is Managing Director and Portfolio Manager at Simplify ETFs. So we will be discussing private credit in ETFs and also the credit markets in general. Until then, have a great week, everyone.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.